On February 9th, I opened this Roth account with one goal in mind: to build a market-beating portfolio over the long term. If you've been around for the first 3 months of this portfolio, then you will know that it has been an absolute roller coaster. Artificial intelligence CapEx spend, Iran war, oil prices, earnings season, and so much more has happened in 2026, and it has left many investors wondering what to think. And I'm no different. My portfolio consists of only 3 stocks. All 3 have been out of favor with the market, yet I'm still confident this portfolio will outperform. In today's video, I am going to be going through a specific stock that I think has fallen victim to this market herd mentality and why exactly I am buying more. I think that this is a company that has great fundamentals, yet is fallen victim to short-term sentiment. So my name's Jack, and let's get right into today's video. With this portfolio being so young, we are extremely concentrated in trying to build out the foundation. All 3 of the stocks in my portfolio have been selling off in 2026, which I love. If you've been following along with my channel for a while, then you know that I am welcoming the opportunity to buy these stocks at lower prices because I believe they are fundamentally great companies. Each one has its own market fear. Like for Meta, is the CapEx spend too much for them to handle? Are they getting any ROI? I believe so, but I'll talk about it exactly why later. Then you have Microsoft. Is AI disrupting their business? Will Office 365 cease to exist? And finally, the newest position, which is MasterCard. Are stablecoins going to undermine what MasterCard and Visa have built over the past couple decades? There's a level of uncertainty with all 3 holdings in my account today, and that of course creates selling pressure in the market. Investors believe that the future looks extremely murky for a lot of these companies, especially companies like Meta and Microsoft. Psychology plays such a big role in the portfolio management and investing space as well. We all know the strategy is to buy low and sell high and to just hold our investments for decades and let them compound. However, when the market sells off and our portfolios decline, all that common sense goes out the window, especially for newer investors. It's proven that people feel the pain of losing money more than they feel the joy of gaining money. When markets are red, people tend to lose their cool and all sense of logic. And I believe it's only gotten worse in recent years. With all the noise from analysts, YouTube, financial commentary on X, accessible apps that show us the swings every single day like Robinhood or Webull, it's no wonder that young investors are losing their way in the market. Not to mention all the meme stocks and hype and fear of missing out that is promoted online surrounding certain stocks. It influences people to make investments in certain securities at their peaks, not at their lows when they are at their best value. Modern day investing comes with its own unique sets of obstacles for investors today, especially beginning investors. But also with that, there's also a new opportunity for modern day investors that investors in the past didn't necessarily have. Any financial metric, news story, or KPI is at the tips of our fingertips. We can research anything we want about any company we want in a matter of seconds. And as an investor in 2026, you have to use this leverage to your advantage. When companies like Meta or Microsoft or MasterCard sell off due to short-term sentiment, look up and build your own thesis. Is the news, is the fear behind these companies warranted for the sell-off? Or do you see fundamentals rising? Is the story being blown out of proportion? Use the technology that we have today to make better investments and build your own conviction. And today we are going to investigate Meta's CapEx narrative and decide if the negative sentiment is warranted. And spoiler, it's not warranted at all. So Meta announced that they are planning to spend between $125 to $145 billion in CapEx in 2026. Obviously, this is a massive investment and is going to restrain free cash flow over the next few years, especially if CapEx spend continues to rise. Companies like Meta, Amazon, Microsoft, and Google keep raising their spending expectations, which has left many investors nervous. There's so much uncertainty surrounding the actual returns and depreciation schedules on all this equipment still, and it leaves investors and analysts scratching their head. And investors hate uncertainty. They want results and they want them now. However, with the AI race, it's not only about getting results. The results need to be explosive, they need to be consistent, and they need to be growing for investors and analysts to be happy. As long as the results are murky, these companies will continue to sell off. That's how the market moves in the short term. It's a sentiment-based game. The market focuses on the headlines, not necessarily the underlying fundamentals for companies. And this was evidenced in the most recent earnings season. Google Cloud grew 63% in the past quarter. This was explosive growth. As a result, investors rewarded Google's growth with a 10% bump in stock price. So Google is now flirting with $400 per share. It is viewed as an AI darling and a leader on this new frontier. At least that's been the sentiment recently. But it wasn't always like this for Google. Many of you may remember that just last year, Google sold off to $140 per share. The sentiment was that Google was going to be killed off by AI. ChatGPT was said to be taking Google's lunch. As we know now, none of that ever happened. Google turned out fine. Yet back in the short term, back in 2025, everyone was saying that Google was going to be the next eBay. They were a dying business. The only people that knew that this narrative was false were the people that were tracking the fundamentals, the people that were looking into the earnings report that Google was putting out quarter after quarter. They saw searches growing, revenue growing, margins expanding, free cash flow growing. Everything was looking great for Google, except investors kept saying that it was the next eBay, which couldn't be farther from the truth. So as an investor in 2026, I'm using the technology to my advantage. Let's look into Meta, look at how AI is actually impacting their business and whether this CapEx spend is not warranted. Let's see if Meta deserves to be sold off rather than just following the market hype. Let's look into the actual earnings report and the actual fundamentals of the company, because that's what smart investors do. And I'm following that same playbook for Meta. This past earnings season was rough. Their stock price fell 8 to 10% after they reported, and it was due to their CapEx guidance, which they upgraded to that $145 billion figure as mentioned before. Short-term sentiment around Meta is extremely negative right now. Investors are viewing their AI investments as a cash burn rather than an actual investment, calling it the next metaverse. But is that true? Does the sentiment match the fundamentals? We can start with their revenue, where they reported 33% revenue growth. That is extremely fast growth. And if you extrapolate that out and look at the past 5 quarters, you can see revenue has only grown faster and faster. In Q1 of 2025, so just a year ago, they were growing revenue at a 16% rate. Now, in Q1 of 2026, they just reported a 33% revenue growth rate. Throughout 2025 and now into 2026, Meta has focused on artificial intelligence. They've recruited and built out an AI team that is full of the best minds in the technological world. And Mark Zuckerberg has paid a pretty penny for them. Why? Because Meta has the most to gain from AI. 98% of their revenue comes from advertisements. Artificial intelligence has proven to make targeting ads better and even help design more effective ads. And this leads to better conversion, which means more customers are paying more. This strategy is once again visible in the raw data. Average revenue per user on Meta's platform has grown from $12.36 a year ago to now $15.66. That's 26% growth. Users are spending 26% more from Meta's advertisements than they were a year ago. And this is what returns on AI look like. But this is just the base case for Meta. Of course, AI is going to make them a stronger advertiser. In fact, Meta is on track to surpass Google as the largest advertising company in the market. But what we know is that Mark Zuckerberg wants to do more with artificial intelligence. He wants to build out a consumer AI, an AI assistant that could assist users in their day-to-day tasks, shopping, and be visually sound. The Meta glasses are just the first step. The long-term goal will be to have this assistant truly be within your vision, and it will be able to process exactly what you are seeing in real time. Of course, this is just a goal for now. Uncertainties remain around how exactly this will be implemented and how it will be adopted by consumers. But what we can tell is that Meta is making real strides, and this was evidenced in the release of Muse Spark. Muse Spark is Meta's AI platform that has been built and designed to service billions of people. It doesn't satisfy a niche or specialize in one purpose. It's a broad platform that combines the networks of Instagram, WhatsApp, Facebook, and Messenger, and the smart glasses. What Muse Spark thrives is in consumer use. It helps users shop and provides personalized recommendations using your data from your socials. It also combines the social integration aspect and leverages the Instagram and Facebook network. This network of 3.5 billion people is something that ChatGPT and Google models can't replicate. Meta knows its users at a very personal level. It gathers search queries, what keeps your attention, what you like and don't like, what you post, and who you are overall. So while Google and ChatGPT may take on more search queries, they're limited in their knowledge of their user base. Muse Spark has been a top 10 downloaded app in the App Store since its launch. People are loving it because it focuses on something new. Rather than being a great coder or business enterprise integration like Anthropic, Muse Spark specializes in social AI, personalized recommendations, shopping, visual reasoning, and complex agentic workflows, truly focusing on that AI agent aspect. Users of Muse Spark don't need it to code. What they need it to do is to be able to give advice, interpret videos or photos that they see on Instagram or Facebook. Zuckerberg knows his user base, and he knows what Meta can thrive in with artificial intelligence. On top of that, Meta is trying to make this AI platform one of the most efficient AI platforms in the market. Of course, Meta has 3.5 billion users. If they want to push out Muse Spark to 3.5 billion users and be able to have it push out information quickly and efficiently, they need it to be low cost. So Meta is building out that AI infrastructure in order to facilitate this large network that Meta already has, because these are all potential adopters of Muse Spark in the future. They have a large market base to work with. Meta knows that their next AI model doesn't need to automate workflow tasks or replace software developers. They know that their AI model just needs to be visually sound. It needs to be able to interpret videos or images and be able to give you a correct and accurate answer. And it needs to be able to do that quickly. That is how Meta expands its moat and makes an AI platform useful for the already existing network that Meta has with WhatsApp, Facebook, and Instagram. So yes, while Muse Spark trails Gemini and ChatGPT and Anthropic as far as coding, Meta knows exactly what it needs to prioritize in. It needs to be able to give answers fast and efficiently, and users are currently loving Muse Spark. The numbers are clear. AI is boosting Meta's top line. Heavy CapEx is going to restrain cash flow in the short term, and that's the cost of this AI build-out. Investors are used to Meta running a capital-light business that just rakes in cash. This investment into AI is ruffling the feathers of a lot of investors and is the primary reason for the sell-off. Investors aren't used to this heavy investment and heavy cash spending. However, this free cash flow restraint is short-term. This isn't going to be the long-term story. If Meta wanted to shut off this AI project tomorrow, they could, and free cash flow would pop right back up. So after my research, I've determined that Meta is a growing and actually accelerating business. There's nothing fundamentally wrong with the company other than massive CapEx investment into an artificial intelligence race that is currently providing value to Meta's company. I think the short-term market sentiment is driving price right now, but I believe over the long term that the stock price will catch up to Meta's growing fundamentals, and this will be a stock that will be much higher in the future. What I see with Meta is an extremely dominant moat company. No one can replicate the Meta ecosystem and the staying power it has. Not to mention, this moat is expanding and growing. Revenues are growing at a 33% rate, despite it being a $1.5 trillion company. Yet it's trading at an 18 forward PE, one of their cheapest valuations ever. It trades for the same forward PE as the average company in the S&P 500. Meta is a far greater and more valuable company than your average stock in the S&P 500. For all this and more is exactly why I'm buying Meta. It's positioned as a 50% position in my portfolio, not only because I feel so strongly about its future, but its valuation is dirt cheap. The short-term price movements won't deter me, and I will continue to buy at these prices. So thank you guys for tuning in to today's video. As always, leave a like and subscribe, and I'll catch you in the next one.